Hello, everybody. We have Tony Weedle with us today. He is an independent insurance agent based in Canton. And we're going to start by talking about home insurance. Tony, go ahead.
Well, hi, everybody. Last year, I was able to come to the class live and in person, and so this is a little unique, but I suppose we're all getting used to these videos and the like. I've been in the insurance business for 11 years now. I own and operate my own independent insurance agency just 15 miles east of you, and it's been a fun adventure, shall we say. But today we're going to talk about home insurance, and we'll also sprinkle in a little bit about renter's insurance as well, as we talk about how do we cover those things, those tangible things that we own in our personal life, and how do we protect them. And then also, what happens if we happen to be legally liable for an incident? What happens if I, in my daily life, happen to cause injury to somebody else's either person or property, and how might a homeowner's or renter's policy respond? And so you don't have to look at my ugly face this whole time. I wanted to share an insurance declarations page with you on a homeowner's policy, and that way we can kind of review the coverages. So when you purchase an insurance policy, there is what is called a declarations page, and it is always the first few pages of your policy. And this basically provides a summary of coverage of what is happening, what is being covered for you. And so this particular one is just one page. It's just right here. This is a home insurance policy that I've written here in rural McPherson County. And we're just going to kind of walk through the coverages here together. So what you will find in all homeowners policies is this section right here. The first section is always property coverages, and it's always A, B, C, and D. They may label them a little bit differently, but you'll have coverages A, B, C, and D. And the first coverage, A, is how much are we covering the house for? How much are we covering the house for? And in this particular case, this house is covered for $310,800. Now, that value is determined based upon a replacement cost estimator that we use with the insurance company to determine what would it cost to rebuild this house with like kind and quality materials. This particular home is 20 years old, and it wouldn't have cost $310,000 to build it 20 years ago. But if it were to blow away in a tornado or burn down, and the customer needed to rebuild it, that is what the insurance company is estimating it will take to rebuild it. And so you can see out in the rural part of the county, the premium is $1,973 a year. What drives this premium number? Let's talk about that for a little bit. Premium is driven by several things. One of the things, and I've already mentioned it, is it's in a rural part of the county. And so we look here to this protection class number 6. In the city of McPherson, where you're going to school, the protection class would be a 2. That's a great fire protection class. That's because there's a fire department. They've got Class A pumps. They are fully staffed, and they're ready to respond as soon as a 911 call is made. In Canton, where this property is at, this is a property outside of town, and so its protection class is a 6. It's 3 miles outside of Canton, and we have a volunteer fire department here in this community. And so when someone calls 911, people have to leave their jobs, leave their house, get to the station, and then get going. So there's a delay in response. In addition to that delay, there's also there are not fire hydrants out in the rural parts of our county. And so we have to shuttle, the fire department would have to shuttle water to that scene, affecting their ability to put out the fire. And so you'll see protection classes from 1 all the way up to 10. And then after 10, it's unprotected. So if you're 15 or more miles away from any fire station, you would be in an unprotected area. And it's one of the larger drivers of the premium rate that we see here. Other things that factor the premium, go into factoring the premium, is the type of construction. Most homes are wood frame construction, but if you happen to be, I've seen sod homes, I've seen where people build outbuildings or sheds, and they live in part of the shed, and then they maybe, you know, have an oversized garage on the other side, and it may be a steel frame instead of a wood frame construction. So the type of construction matters. The other thing that matters is territory rating and zone. And you can see this is in zone number 7, and it's actually getting a credit of 12, not quite 12% against the base rate on the policy. That's because when they look at Kansas, this particular area has a less likely chance of wind, tornado, hail, earthquakes, those kinds of things. And so there's actually a bit of a credit against the base rate. Now, each insurance company has their own rating factors, and they are applied to the premium in different ways. They all have their own complex algorithms and how they determine premium. Since we're talking about premium, let's talk about a few other things that affect a person's cost when they're buying insurance. The number one thing that you can do to drive your insurance rates lower, whether it's home, auto, even life insurance these days, is your credit score. What insurance companies have found out, and this has been around for about 25 years, is people with low credit have more accidents, have more claims than people with high credit. Essentially, how you manage your personal life, or how you manage your financial affairs, is how you manage your life as well. And so if your financial affairs are a train wreck, then the insurance company is expecting, and it can be proven statistically, that you're going to have a lot of accidents. In my short career in insurance over the last 11 years, I found that to be true. Anybody with an insurance score under 700, which by the way is a lot of college students, so I'm not throwing stones. It takes a little while to build credit, but anybody under that, typically they just have more claims. And once you become more established, maybe you purchase a home, you settle down, you've got you know, good paying jobs and whatnot, your credit score starts to creep up and you're more stable. And so credit score is the number one factor, even above the fire protection class and the territory rating.
Hey, Tony.
Yes, sir.
In my experience with insurance, when you have a good credit score, say over 700, then for insurance purposes, you're lumped into a bucket as you're a good client. It's not that an 800 makes, if you have a credit score of 800, that it becomes cheaper than if you have a credit score of 700. Is that true?
Yeah, that's mostly true. And it's not entirely credit score. So they call it an insurance score, but the biggest driver of your insurance score is your credit. The other factors will be your age, location where you're living, and so, you know, whether or not you're married or not. Some of those are going to drive the overall insurance score. And each company, here in this particular case, we're looking at Marysville Mutual Insurance Company. They will have 3 different insurance companies where they will place risks, and they look at your insurance score to place you. So anyone with, say, an insurance score above 750 will be in their most preferred insurance company, where it has the best rates. And then they may have a middle tier between, and I can't remember the number I used, between 650 and 750. And so that'll be this company. And then anybody under 650 will be kind of in their lower tier company. It's the same insurance coverage, but from a rating standpoint, that's how it works. And then on the back end, not to get into too much of the weeds, but insurance companies buy insurance themselves to protect against catastrophic risk. And so on the ultra preferred risks, the insurance company may choose to keep or retain more risk in that pool, where in the lower tier, they may opt to buy more reinsurance or have additional help in this bucket, because they know there's going to be more claims with this group of people. That answer your question?
Yeah, it does. Thanks.
Okay, great. So we were talking about things that affect rate. We've talked about the age of the house, type of construction, the age of your roof, protective devices like smoke detectors, burglar alarms, fire alarms that call the fire department or police automatically, the area in which you're living, and so on. So those are kind of, that's coverage A. So that is how much we're covering this person's house for. And then coverage B is related structures, and it is always 10% of the first number. And this is kind of a, hey, this is what you get included. This could be for things like a fence, a playground for your kids, a detached garage, a garden shed, those things that are on your property, that are real tangible property, that are not physically attached to your home. Then the third bucket, coverage C, is for your personal property. This is all of your contents coverage. This is what's not only inside your home, but inside your garage, garden shed, and the like. And it is 70% of coverage A. Some companies are 75, but in general, it's mostly 70% of coverage A. And what's most common is people tell me, oh my goodness, I do not need $217,000 worth of coverage because I don't have that much stuff. Well, most people don't, but the insurance company just throws in this number as a part of your homeowner's insurance package. And if you had a complete fire, it doesn't take people long to really accumulate a pretty large contents inventory when they start making their lists out. You'll notice here that this insurance company, they have a replacement value on personal property, and that's something that is included in the price. Some insurance companies for personal property just insure you for actual cash value. And actual cash value is just a fancy way for saying a depreciated value. So I buy a new television set at Walmart and it cost me $1,000, and I bring it home and I have a house fire 2 years later. They're not going to pay me $1,000 for that television to replace it. They're only going to pay me $600 to replace it because it's a depreciated value. And so when you're looking at home insurance for yourself in the future, or even renter's insurance, you want to make sure that you understand, how are my belongings, how is my property being covered? Is it at replacement value, or is it at the depreciated actual cash value? And I'm not saying the depreciated actual cash value is a bad policy. I write many of those for customers who understand that's what they're purchasing. Because they're purchasing a depreciated value policy, it means the premium is significantly less. And so I'll see that done on larger homes, rental properties, and those kinds of things where they're okay taking a depreciated value. They just want a little bit of insurance in case something happens. And then the last item, coverage D, is additional living expense. And so this comes into play if the tornado comes through and completely blows your house away. This is the bucket of money, in this case $62,000, that would pay for you to rent an apartment for 6 months while your house is being rebuilt, or stay in a hotel. Extra expenses like transportation or whatever the case may be, because you've been displaced out of your home. And these are the expenses above and beyond what you would have had to pay had the event not have happened. Typically, there's plenty of limit here, but there are some policies where they pay a reduced limit here of, say, only $5,000 or $10,000. And in a catastrophic event, it doesn't take any time at all to really rack up a lot of extra expense. And so while it's not used all the time, when it is used, this bucket of money is used quite significantly. And then you can see in this home, we talked about the discounts already. They provide a 2% premium discount because they have a smoke alarm, 2% discount because they have a deadbolt. Believe it or not, I take a picture of the fire extinguisher in their house and they get another 2% credit. And then these folks are non-smoking. Again, insurance companies are worried about fires, and so they provide a 10% discount for non-smoker. So when you're out purchasing insurance and you're visiting with your agent, you always want to ask what credits are available, and to make sure that you're getting the biggest, bang for your premium dollar. So this is how we're going to cover the property. Now, what happens from a liability standpoint? So there's going to be two categories here in personal liability. The first one is just the generic personal liability coverage. And here we have $1 million limit. You can see the premium associated with it is very cheap, only $31. Very common, I'll see this number at $300,000. And often I shake my head because for $300,000, it's probably costing $18. And to go up to $1 million, getting an additional $700,000 of coverage, it's only costing $13 more. So a total of $31. It's very cheap insurance. And we don't see a lot of personal liability claims in the marketplace, but there are a couple of examples I'll walk through to give you an idea of what we're covering in this bucket. So this bucket here is going to be for items that you are legally liable for. You have caused damage to somebody else or their property, and you're legally liable to fix them, repair them, pay for their medical bills. For example, a couple of years ago in Overland Park, Kansas, a family from the central part of the state went to Kansas City, and they were in an art museum, and their little 2-year-old boy thought this it's not a mural, but statue, if you will, was not in a glass case, and he reaches his hand up and he grabs it, and as he picks it up and he leans backwards, it's way heavier than he thought. It falls, it crashes to the ground. It was a famous artist that put that together, and it was $225,000. Certainly the family relied on their homeowner's insurance policy to pay for the damage to that item because they should have kept their son closer to them. And so they were legally liable to reimburse the art museum for that amount. The other common case or common example I use to explain liability insurance to folks is 4th of July. A lot of people tell me, oh, I don't need liability insurance. And I will immediately respond with, do you light off fireworks for either yourself, your kids, or your grandkids? And almost always they will say yes. In Wichita, again, this has been a couple of years ago, a family was shooting off fireworks. One of them landed on their neighbor's house. They caught their neighbor's house on fire, and the house ended up being a total loss. When you look at a house being a total loss, in the example up above here, we're talking $310,000 plus additional structures, plus personal property, plus additional living expenses, plus there were 2 vehicles in the car, which we'll talk about vehicle insurance in another segment. And you can begin to see, as we start doing the math here, it doesn't take long to come up with, $500,000, $600,000, $700,000 worth of damage, all because you were just having fun on the 4th of July and trying to, take as many precautions as possible. And yet a firework landed on your neighbor's roof and it burned their house down. So those are the types of things that we cover in this bucket. What we don't cover are intentional acts. You intentionally do something. Obviously, that's a criminal case, and so that's handled separately. But these are for accidents, and you have a duty or you are legally liable. This also protects you finally for in case somebody sues you and they sue you maybe wrongfully. For example, maybe you had a family over and all the kids were jumping on a trampoline, and you told the kids that they needed to, be safe and zip the deal up, and their parents were there, but they didn't have the protective net around, and the kid falls off the trampoline and gets hurt, and their parents were there, and their parents get mad and sue you. Well, I'm not sure, that's kind of a messy case. I'm not sure if you were legally liable for the kids since their parents were there and you had told them to take safety precautions, but you get sued anyway. Well, regardless, the insurance company is going to pay for your attorney fees to defend you in that case and determine whether or not they owe anything. And so liability insurance is very important. And then the last little category here is medical payments to others. This is for what I call slip and fall coverage. And this is to prevent people from jumping, from somebody wanting to maybe potentially sue you and the insurance company having to dip into the $1 million bucket. So for example, you have the sidewalk leading up to your house has a little bit of disrepair. There's a little bit of a lip. You have company coming over and they walk up and they trip and they fall and they twist their ankle and they've got to go to the emergency room. Well, the insurance company wants to help them with some of their out-of-pocket costs, in this case up to $5,000, so that way they don't sue you and dip into the $1 million bucket. So this is just a way for them to say, hey, I realize I'm not sure whose fault it is, but they did get hurt on this property. And so we want to kind of cover maybe their medical deductible for their health insurance, or maybe pay for a little bit of therapy or whatever the case may be in order to kind of make it go away. So this is kind of a slush fund to make it go away if somebody were to get hurt on your property. And then in all insurance policies, and there's a second page that I won't show you here today, but there's these mandatory forms and endorsements. And these are gonna modify the insurance contract and often exclude coverage, or maybe potentially include coverage. And so there's certain things in here, and this particular company does things a little bit different, but you see they're giving more coverage for refrigerated food products. But they've got a specific Kansas liability coverage section, or they come up here to the top and they're excluding any fungi, wet or dry rot or bacteria. They're not going to provide any liability for those kinds of things. So these exclusions are really important. In a homeowner's policy, down here towards the bottom, you will always see motorized vehicle liability coverage is always excluded, because that's what we have auto insurance for. And so they're saying, look, if something were to happen in a car accident, we don't want the $1 million on your homeowner's insurance policy to cover your liability for cars. We only want that for other personal things that might happen. You need to purchase a car insurance policy to cover the car. Other common exclusions in a standard homeowner's insurance policy are things like flood, earthquake, anything related to business pursuits. That's what we have business insurance for. We talked about it, mold and rot. We talked about intentional acts, vicious dog breeds, so German Shepherds, Pit Bulls, and the like. They're not saying you can't have them. They're just saying if something were to happen with those dogs, they were to bite somebody or whatnot, you wouldn't have any liability protection. I used the example of a trampoline earlier. Some insurance companies like trampolines and some don't. And then intentional acts and fraud. So if you're committing any type of insurance fraud, those types of things would be excluded. Now, what is covered? There are really 3 different kinds of insurance policy forms that you can buy. You can buy a basic, a broad, or a special form insurance policy. The basic insurance policy covers mostly acts of God and a few other items. So I'll just read them off to you, and it's the cheapest. Fire and lightning, smoke, wind, hail, explosion, riot, which, you know, here in 2020, we've seen some of that happening. Aircraft were to crash into your home, vehicle crashing into your home, vandalism, and theft. So those are the basic perils. Then for a little bit of extra money, you get all of those that we talked about, plus falling objects, collapse, weight of ice and snow, freezing and bursting of pipes, and power surge. And those perils are called broad perils. So we get all the basic perils, plus we get those additional ones. What's most common in the marketplace, however, is special form coverage. And it's what we call all risk coverage. And that is what is quoted on this insurance policy here in front of you. And what we're saying here is everything is covered except what is excluded. And we talked about the exclusions already, most commonly flood and earthquake. But we're going to cover anything and everything that you could dream up that would happen unless we've specifically excluded it in the policy. So let me give you a quick example. Some people, when they're sitting before me, they say, well, I'm just worried about a fire and I'm worried about a tornado and hail. And yeah, freezing and bursting of pipes would be great, but I don't need special coverage. I'd like to save a little premium. Well, we've seen on YouTube or Facebook and the like, those videos of a deer crashing into somebody's home, right? You've got a nice sliding window or back door, or you had the screen door, the glass door open, and there was just a screen, and they come crashing into the house and they tear up your house, and then they leave, and your contents have been destroyed and the inside of your house has been damaged. If you don't have special coverage, then you would not have any coverage for that type of accident, because remember, in special form coverage, we're covering everything unless it's excluded. Well, I can assure you in the insurance contract, there isn't an exclusion for a random deer running into your home and causing damage. So we would have coverage in that case. But if you only have the first two, basic or broad, because a deer crashing into your home isn't specifically listed, then there would be no coverage. Another example would be, and if you have kids and or when you have kids and they have a hammer and they decide, oh, they saw mom and dad outside hammering on things, so I'm going to take the hammer in the house and start hammering holes in the sheetrock in the house. Believe it or not, that would be covered on a special form policy because it's not excluded. So finally, I just wanted to talk briefly about renter's insurance. Renter's insurance uses all the same things that we just talked about, except it doesn't have coverage for A and B. So we're not covering the place you're living and any related structures. And that makes sense because you're renting them, you don't own them, so you don't need to cover the home and you don't need to cover the outbuildings. But what renter's insurance is providing you is personal property, contents coverage, loss of use coverage, liability coverage, and medical payments coverage. And all four of those buckets are really important, especially your liability coverage. Most people don't think about this, but if you have a kitchen fire and you're in an apartment complex and it happens to not only damage your place, what this bucket would be for, but it also damages 4 additional or neighboring apartments, $1 million may not even be enough to cover all of that damage. And so it's really important. And renters and coverage is driven off, most of the price is driven off of how much contents coverage do you need. And most of the time for college kids, for example, we might see something for $20,000. Typically, I tell people it's $10,000 for every person living in the home. That gets us kind of close. So if there's a family of 4 and they're renting a property, we would go with $40,000 of coverage because it's hard to value all of your stuff, but that gives us a good idea. So I think I'm going to pause there and see if there are any additional questions.
Hey, Tony, this homeowner's insurance policy, if we get to the bottom line, it's a couple $1,000s a year. It's been a long time, but in my experience, renter's insurance is pretty inexpensive. You want to give them an idea of what they'd be talking about?
Yeah, absolutely. Typically, renter's insurance is going to be about $15 a month, or say $175 a year. And that would be for about $25,000 of contents coverage and your liability coverages. Of course, what's going to drive that is how much contents coverage you have, where are you living. Buying renter's insurance in McPherson is going to be way cheaper than buying renter's insurance at this rural property outside of Canton. And so all of the same discounts and location parameters apply, but it is relatively insignificant. And really the biggest value, in my opinion, is your personal liability coverage. So.
Okay. What about an umbrella policy?
Oh, yeah, that's great. So we have $1 million worth of coverage here today, and that feels like a lot of coverage. until we kind of went through the house fire discussion of, okay, we had a residence burned down and all of the contents and the automobiles, but all we talked about there was the property damage. So here in this particular case, say we'd have $600,000-700,000 of property damage. Well, what would happen if two people were inside that home and they suffered burns? I'm also liable for their bodily injury as well. And it takes burn victims a long time to recover. And let's just say they had $500,000 worth of medical expenses. Well, we add that on top of the $700,000 of property damage, and now we're at $1,200,000 of loss. Well, the insurance company will gladly pay the $1 million, but that's the largest limit you bought, and so $200,000 is left uncovered. And so what is very common is we'll sell an umbrella liability insurance policy that comes over the top of your house. It also comes over the top of your automobile insurance, which we'll talk about in another segment. And it provides additional limit should the underlying policy here not have enough. And so in this case, if we were to buy, say, $1 million umbrella that covers over the home and covers over the auto, that $1 million umbrella policy would have enough limit to go ahead and pay the additional $200,000 that this underlying policy wouldn't cover. Umbrellas, liability policies are reasonably cheap, a couple of $100 a year. And then the other reason that somebody might want to buy an umbrella policy is as you get older in life, typically, and begin to accumulate things, items, net worth, when somebody sues you, you have things at risk. And so you want to have liability protection to protect your assets. Generally speaking, college kids don't have a lot of assets, right? And so maybe nothing. Maybe they've got their car and a few belongings, and that's it. And so if they were to cause have a big situation and they couldn't pay the $200,000, they could file for bankruptcy. They could say, sue me, I don't have any money, right? But somebody with significant assets and significant net worth, if all they had was this $1 million policy and there was still $200,000 left outstanding, a judge would tell them they would need to liquidate some of their assets in order to pay that additional $200,000. So umbrella policies, I typically don't talk too much about for younger folks who don't have a lot of net worth. But as people start to gain in net worth, it's a conversation definitely need to have.
One other topic, quick. What if somebody has a nice piece of jewelry or a gun collection or something that they feel may not be fully covered by the personal property line item?
Yeah, that's a great question. And I don't believe I mentioned it, but for things like jewelry, guns, stamp and coin collections, silverware, there are sublimits inside the policy where they may only pay for $2,000 worth of guns. Well, if you have a $10,000 gun collection, you would like to have additional coverage for that. And so we can go ahead under the additional property coverages, we can go ahead and schedule on the additional $8,000 of guns. Or from a jewelry standpoint, hey, I've got a $5,000 wedding ring and I want to insure it, but I want to also insure it in case it's mysteriously lost. And I also don't want to have a $1,000 deductible. I would like to have a $250 deductible on my ring. And so we can schedule that ring and have it insured as a part of the homeowner's policy or the renter's insurance policy. But we can have those things covered for specific limits and agreed values. So that way the insurance company can see, okay, yep, there's the appraisal paperwork. Yep, we're willing to cover this ring for this amount of money.
Is a floater the term for that, personal property floater?
Yep.
Okay.
They're floater. Another one is personal inland marine. So it's they're varying terms, but typically they can fall all inside this homeowner's insurance product.
Very good. That covers my list that I wanted to hit on today.
Well, great. Well, I think I am just running through my list, and I think I was able to check everything off as well. So maybe we can wrap this session up.
Yeah, we'll wrap it up, and we're going to have Tony back for another segment shortly. All right. Thanks, Tony.
Thank you.